Today I want to talk about the global opportunity of global real estate. Now, I think people get fixated with listed and global listed. It's real estate, that's what we invest in, real estate. It just so happens that it's listed on the stock market. In the long term, returns will be determined by our ability to choose some of the world's best real estate that we think over the long term will produce a real rate of return and quite a resilient income stream. And the opportunity set is phenomenal. We're able to invest in real estate around the world in various markets and various types. Retail, office, industrial, student housing, logistics, self-storage, residential, you name it. There are listed opportunities to invest in a diverse range of real estate. We're talking about properties that you, I, and most institutions could not afford to buy by themselves. We're talking about buildings like the Empire State Building in New York. We're talking about Carnaby Street in London. A broad range of high-quality real estate that is available to us, providing the diversification, providing the liquidity, something that I think people today are taking for granted. We've obviously had a period of high liquidity, low interest rates, QE. It is not time to be complacent about liquidity. Fungibility, today's word, something to learn, is all about, it basically means that it's transferable in terms of whether you own it as listed or unlisted, it's real estate. And what will happen is that private equity players, like the Blackstones of the world, will look at the listed market for opportunities to take listed REITs private if they're trading at a big enough discount to NTA. The other major factors, and most important to investors, is that it provides incredibly competitive returns over the long term, something that people don't quite, I think, expect. Now, this is 25 years on the left of equities, global equities versus global REITs. Point in time, yes, but it shows through cycle, global REITs can produce competitive returns. And the other great attribute that Mark mentioned earlier is that it comes with a higher component of income. So competitive returns with a higher component of income underpinned by real estate. Now, when we look at the issues fundamental to real estate, what's most important when we're investing is, of course, supply and demand and how the real estate's financed. They're the issues that are most important to how real estate and REITs will perform relative to other asset classes. The diversification, because if you don't have your supply picture correct, if you don't have your debt correct, we will not provide diversification. So you need to have the right fundamentals. And today, what we see on the chart on the right is that we're seeing very high levels of occupancy, i.e. low vacancy rates. And that's despite a prolonged period of economic growth and low interest rates, which is quite surprising because usually when you see this sort of environment, you see a huge amount of flooding of supply, of construction activity. That's not been the case. And as a consequence, landlords in many markets around the world are enjoying pricing power. That means rents are growing at greater than the rate of inflation. So what we do is we monitor supply, which is in that middle chart. And as you can see, supply relative to history is not very elevated, which is to us a great signal for the real estate market. We're seeing many markets in the world, in fact, experiencing near record low vacancy rates and only moderate levels of supply. And then the other factor is, of course, the thing that catches out too many people investing in real estate is too much debt. Now, strangely, despite low interest rates, despite QE and the availability of debt and equity, the REITs have not leveraged up and taken advantage of the low interest rates. So they've been far more disciplined in their capital management. That to us means that with this supply-demand picture and leverage, it means that the sector can produce diversification within balanced portfolios. So what do we think the major issues are for real estate over the next, say, 3 to 5 years? We think the residential affordability is going to be an increasingly topical issue. Australian tenants are not afforded particularly great protections relative to other markets in the world. And we're starting to see the affordability issue really become important in more and more global cities because of urbanisation, lower interest rates and high house prices. Now in Berlin, where they've seen strong market rent growth, the government has been forced to bring legislation before Parliament to freeze rents for renters for 5 years. That's perhaps an extreme, but it's what we're going to see in more residential markets around the world. In fact, we've seen similar initiatives to some degree in markets like New York, and the Lord Mayor of London has also called for rent regulations in London. Retail property, I don't need to tell you, is obviously going through an important transition period due to e-commerce. Now, this has major implications for Australian institutions through their real estate exposure. They have very high exposure to retail property. And on our analysis, we think valuations are somewhere between 10 to 30% above trading values. In other words, the valuers are behind the current market. So that's going to be a major issue. And the other thing that we also are concerned about is tenant credit. Now, we just saw in the metrics presentation, you saw very low levels of defaults on loans. The market hasn't been stress tested for quite a number of years because of low interest rates, QE, and pretty reasonable economic growth conditions. So that's a factor that we need to be mindful of as a through cycle investor. Now, when I talk about global REITs, people I don't think quite understand what that means. If I talk about global equities, we know about the FANGs, we know about Procter & Gamble or Ford or John Deere or Bank of America. But if I talk about global REITs, what does it mean? So I thought maybe worth just highlighting a couple of names to give you a flavour of what's available. I'm not suggesting these are cheap. I'm not suggesting that you should go out and buy them. I'm just highlighting the opportunities and the diversity and the quality of the cash flows that some of the global REITs are producing. Stocks like Assura. Assura owns 555 GP clinics around the UK. Now, the great thing is they've got long-term leases that are backed by the National Health System, the NHS of the UK. So it's effectively government credit on basic needs healthcare. That stock has a loan to value of less than 35% with government effectively credit. It's been growing its earnings and its dividends at a very good pace, and the stock's still producing a dividend yield of 4%. Now, why we highlight that is because that stock, since the eve of Brexit, not the day of or the day after, but before Brexit, which was unexpected, that stock's up over 20% because it's providing a fantastic cash flow. Then we've got Prologis. Now, many of you here today would be familiar with the local Goodman Group. This is the global competitor to Goodman Group. It's in fact the largest REIT in the world today. It's called Prologis. They have assets in North America, in Asia and Europe, and they are riding the e-commerce boom. So they're in fact benefiting from the likes of Amazon and their push. Amazon's going to be pushing for same-day delivery within the next 24 months. They're currently doing 2 days, they're trying to get it down to same-day delivery. Prologis has the properties that Amazon need to be able to facilitate that distribution. And as we know, there has been a very significant shift from retail shopping centres to online. The other stock I think worth highlighting is one called Equity Lifestyles. They own manufactured home communities that we would typically call trailer parks. Some people might, I think, unfairly call it trailer trash. We call it trailer cash. The reason is, the great thing about this vehicle is it owns trailer parks dotted in mostly coastal regions around the US, affordable living. They own the land. The occupant puts their own home on the land and pays a land rent. That means Equity Lifestyle doesn't have to pay to get the roof repaired, the kitchen repaired, the bathroom repaired, the painting, all of those things that are involved in tenanting properties. So it's a great quality cash flow, affordable living with great demographics, because older generations, they call them the snowbirds. They fly south in winter into these coastal locations in an for affordable living. Again, it's been a phenomenal through cycle return. So we think by being selective, by carefully choosing some of the world's best real estate that happens to be listed, you can generate fantastic returns. So if you've got any questions, please contact the guys at Pinnacle, or you can find more details on our website, rescap.com. Thanks for your time.